My friends, today we're diving into the stress-free way to get rich after 50, and what you're about to discover might completely change how you think about building wealth in the second half of your life. Have you ever wondered why some people reach their golden years with financial freedom while others are still struggling paycheck to paycheck? What if I told you that the secret to building wealth after 50 isn't about taking bigger risks or finding the next hot investment, but actually doing the complete opposite? Has this ever happened to you? You open your social media and see yet another headline about some 25-year-old who became a millionaire overnight with cryptocurrency or real estate or some new tech company, and you feel that pang of urgency, that voice saying you're falling behind or it's too late for you. That feeling of urgency, that desperate need to catch up, is actually the most dangerous enemy to building real, lasting wealth. As Charlie Munger, Warren Buffett's right-hand man who lived to 99 and amassed billions, often said, financial success isn't about brilliance, it's about avoiding stupid mistakes driven by urgency. The desire to get rich quickly is the oldest trap in the world, and it becomes even more dangerous after 50 when you have less time to recover from major financial mistakes. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Stay with me until the end, because what we're discussing today isn't some get-rich-quick scheme. It's quite the opposite. It's the counterintuitive approach that has created more millionaires than all the lottery winners combined. You see, true wealth accumulates gradually through consistent actions and rational decisions. While getting rich slowly might sound boring, especially when you're over 50 and feel like time is running short, boring actually works. By keeping costs low, reinvesting earnings, and avoiding catastrophic risks, wealth will creep up on you over time in ways that might surprise you. I remember speaking with Robert, a 63-year-old former teacher who followed these principles. He never made more than $70,000 a year, yet he retired with over $2.2 million in assets. How? Not through brilliance or lucky investments, but through the disciplined consistency we'll be exploring today. The fastest way to build wealth, especially after 50, isn't through excitement or high-risk ventures. It's through embracing what most people consider too boring to follow. While everyone else is chasing the next big thing, those who truly understand wealth building are quietly following timeless principles that virtually guarantee financial security. What if I told you that by the end of this video, you'll understand why getting rich slowly is actually the fastest and most reliable path to wealth after 50. And more importantly, you'll know exactly how to implement this approach in your own life, regardless of your current financial situation. What most financial advisors won't tell you is that preparing for the inevitable economic storms is just as important as growing your money. One of the most profound mindset shifts that happens when you embrace this stress-free approach to wealth is accepting that economic downturns aren't just possible, they're guaranteed. Think about it. In just the last 25 years, we've experienced the dot-com crash, the 2008 financial crisis, and the pandemic market plunge. Yet so many people act shocked each time, as if economic cycles are some kind of revelation rather than a fundamental truth of financial markets. The hidden wisdom here comes from studying what happened during the Great Depression. Families didn't lose everything because they weren't hard-working or intelligent. They lost everything because they took on too much risk during the good times, leaving themselves completely exposed when the tide went out. This pattern repeats itself in every generation, and the transformation comes when you position your finances to not just survive, but potentially thrive during these inevitable downturns. Now, I want to go even deeper into this topic by exploring what true wealth building actually looks like on a day-to-day basis. It's not about finding that one magical stock that goes up 1,000%. It's not about timing the market perfectly. The journey to financial independence after 50 is much more mundane, and that's exactly why it works. Real wealth is built brick by brick, deal by deal, with no fireworks or genius moves. It's making one solid decision after another over time. It's adding to your investments consistently, regardless of what the headlines are screaming. It's having the discipline to stick with your plan when everyone else is either panicking or euphoric. I often tell my clients that if you want excitement, go to Las Vegas. If you want wealth, embrace boredom. This approach requires a certain kind of courage, not the adrenaline-pumping courage of taking big risks, but the quiet courage of sticking to your principles when everything and everyone around you suggests doing otherwise. What's fascinating is how this approach creates an entirely different relationship with money. Instead of the constant anxiety of wondering if you're making the right moves, you experience a profound sense of peace. You're no longer at the mercy of market swings or economic news. Your financial foundation becomes so solid that external events lose their power over your emotional well-being. I remember working with Margaret, who at 58 had just gone through a difficult divorce that left her with only half the retirement savings she'd planned on. She was tempted to make aggressive investments to catch up, but instead embraced this brick-by-brick approach. 7 years later, through consistency and patience, not brilliance or luck, she'd not only rebuilt her financial security but was actually ahead of where she would have been. If you found value in these principles for building wealth after 50, hit that subscribe button to join our growing community of rational investors. I'm committed to sharing strategies that actually work without the hype or unrealistic promises. If you're nodding along to these principles, type "Patience pays" in the comments. I'd love to know who among you understands that true financial freedom comes from this countercultural approach to wealth building. One of the most powerful revelations that changed my own financial journey came when I realized that envy is perhaps the most destructive force in wealth building. We've all felt that twist in our stomach when we see someone else achieving what we want. That neighbor with the new luxury car, the colleague who retired early, or that friend who seems to hit every investment home run. But here's the hidden truth. Envy gives you absolutely nothing except misery. It's the only negative emotion that provides zero benefit. At least anger can motivate action. Fear can protect you from danger. But envy? It only paralyzes you with discontent while simultaneously pushing you toward poor financial decisions. I've witnessed countless people in their 50s and 60s make catastrophic financial mistakes simply because they couldn't bear watching others get rich while they felt left behind. They jumped into cryptocurrency without understanding it, leveraged themselves into real estate at market peaks, or put their retirement savings into hot stocks their golf buddies were bragging about. The profound mindset shift happens when you stop measuring your financial progress against others and instead focus solely on your own journey. When you spend decades steadily compounding your wealth through rational decisions, it genuinely doesn't matter what anyone else is doing. Your results will be excellent, regardless of whether your neighbor struck it rich in tech stocks or not. This connects directly to another crucial principle. The quality of your investments matters far more than getting a good deal. Many investors, especially those feeling behind, fall into what Warren Buffett called cigar butt investing, buying mediocre or declining businesses simply because they seem cheap. The metaphor is finding a disgusting cigar butt on the sidewalk and thinking, "Hey, there's one free puff left." The transformation comes when you realize it's far better to buy excellent businesses at fair prices than mediocre businesses at bargain prices. Quality companies with strong competitive advantages, growing markets and excellent management will compound your wealth almost effortlessly over decades. Meanwhile, those bargains often turn out to be value traps that continue deteriorating. This principle becomes even more important after 50, when time is more precious. You simply can't afford to waste years holding on to declining businesses, hoping they'll turn around. Your focus should be on owning pieces of businesses so excellent that time is your ally, not your enemy. I've seen this play out dramatically with clients like David, who at 55 switched from chasing undervalued stocks to systematically investing in companies with dominant market positions and pricing power. The impact on his portfolio growth was so significant that he was able to retire 2 years earlier than planned, despite starting this approach relatively late. If you've ever found yourself tempted to invest in something mainly because it seemed like a bargain rather than because of its quality, type quality first in the comments below. Here's something counterintuitive that the financial industry rarely talks about. Studying failure is often more valuable than studying success. We're constantly bombarded with stories of financial triumphs, the investors who timed the market perfectly, or the entrepreneurs who built billion-dollar companies. But behind the scenes, there's a profound wisdom in examining what went wrong instead of just what went right. What most people don't realize is that mistakes don't just cost you once, they compound over time, just like good investments. Hold on to a flawed financial strategy long enough, and it doesn't just maintain its original cost. It multiplies your losses exponentially. I've witnessed this painful journey with many clients who came to me after years of doubling down on failing strategies simply because they couldn't admit their initial decision was wrong. The revelation here is that financial success doesn't require extraordinary brilliance. You don't need to be the smartest person in the room. What you need is the humility and wisdom to recognize and learn from mistakes, especially your own. This becomes even more crucial after 50, when recovery time from financial setbacks is more limited. I remember working with Richard, who at 62 had spent nearly a decade trying to recoup losses from an investment in a friend's business venture. The business had shown clear signs of failure within the first year, but Richard kept investing more, hoping to average down and eventually turn things around. The breakthrough in his financial transformation came not when he found some amazing new investment, but when he finally confronted this pattern and redirected his remaining capital towards stable, proven investments. This brings us to another cornerstone principle that has guided the most successful investors: understanding your circle of competence. The authentic path to wealth building isn't about trying to master everything. It's about clearly defining what you genuinely understand and staying firmly within those boundaries. Consider this. Warren Buffett and Charlie Munger, two of history's greatest investors, largely avoided technology stocks for decades, even during the internet boom, simply because they couldn't predict with confidence which companies would ultimately win. This wasn't weakness. It was one of their greatest strengths. They understood that knowing your limitations is infinitely more valuable than pretending to know everything. For those of us building wealth after 50, this principle offers tremendous freedom. You don't need to understand cryptocurrency, options trading, or the latest fintech innovations. You simply need to identify the areas where your experience and knowledge give you genuine insight, and then focus your investments there. The impact of this approach isn't just financial, it's emotional. When you stop chasing investments you don't fully understand, you eliminate a tremendous source of anxiety from your financial life. You no longer wake up wondering if you're missing out on something, because you've made the conscious decision to excel within your defined circle rather than fumble outside of it. If you've ever made an investment decision based more on hope than understanding, type "know your circle" in the comments. We've all been there, and recognizing this pattern is the first step toward changing it. Perhaps the most challenging aspect of building wealth, especially after 50, is maintaining your emotional equilibrium when markets go wild. The psychological dimension of investing is rarely discussed in financial planning, yet it's often the decisive factor between success and failure. Markets are fundamentally driven by two primal emotions, fear and greed. And when markets swing dramatically, either up or down, these emotions intensify to the point where most people completely abandon rational thinking. I've witnessed this phenomenon firsthand during every major market event of the past 3 decades. When the market plunges, perfectly sensible people sell quality investments at fire sale prices. When markets soar, these same individuals throw caution to the wind and buy at astronomical valuations. It's a predictable pattern that plays out with remarkable consistency across generations. The breakthrough moment in any investor's journey comes when they develop the inner fortitude to act contrary to these emotional waves, to be greedy precisely when others are fearful and cautious when others are euphorically greedy. This mental discipline creates enormous advantages, especially for those in their 50s and beyond who have the wisdom of experience on their side. I remember sitting with Elaine, a 57-year-old client, during the market crash of 2020. While her friends were panic selling, she made the courageous decision to actually increase her investments in several outstanding businesses whose prices had been slashed despite their fundamentals remaining intact. That single decision, that moment of clarity amid chaos, accelerated her financial timeline by years. This contrarian mindset connects directly to another powerful principle: learning to value what others don't. While the herd chases the same hyped opportunities, exceptional returns often come from looking where others aren't looking, from finding value in the overlooked and unfashionable. The revelation that changed my own investing approach was understanding that the best time to buy isn't when everything looks perfect. It's when solid businesses with strong fundamentals experience temporary problems or operate in sectors that have fallen out of favor. This contrarian approach requires both courage and independence of thought, but it typically delivers superior returns over time. Think about some of the most significant wealth creation in history. It didn't come from following consensus, but from seeing value where others saw problems. Behind the scenes, this is how generational wealth is often built, not through timing market highs and lows perfectly, but through recognizing intrinsic value that the market temporarily misprices. For those building wealth after 50, this approach offers a particular advantage. Your decades of experience have likely given you insights into certain industries, business cycles, or consumer behaviors that younger investors simply don't possess. This lived experience becomes a powerful lens through which you can identify mispriced value that others miss. If you've ever found yourself hesitating to make an investment decision that went against the prevailing sentiment, even though your analysis told you it was right, type contrarian courage in the comments. That moment of hesitation is exactly where financial transformation often begins. One of the most profound revelations in financial wisdom comes from studying history. While most people focus solely on current trends and forecasts, there's extraordinary insight available to those who understand historical patterns. As Mark Twain reportedly said, "History doesn't repeat itself, but it often rhymes." This perspective creates a powerful advantage, especially for those building wealth. After 50, consider the lessons from the Great Depression, an economic catastrophe that shaped an entire generation's relationship with money. Those who lived through it learned principles about financial survival that many have since forgotten. Behind the scenes of every major economic downturn, you'll find the same patterns recurring. Excessive optimism followed by panic, debt-fueled speculation followed by forced liquidation, and the painful reminder that nothing Absolutely nothing in economic cycles is permanent. The mindset shift that creates lasting wealth incorporates these historical insights. Don't assume good times will continue indefinitely, even when experts insist this time is different. Don't rely on credit to maintain a lifestyle beyond your actual means. And perhaps most importantly, don't position yourself so close to the financial edge that a single significant downturn can wipe you out completely. I've seen this journey play out repeatedly with clients in their 50s and 60s. Those who weathered economic storms successfully weren't necessarily the highest earners. They were the ones who maintained adequate reserves, avoided excessive leverage, and never forgot that economic winter inevitably follows summer, regardless of how long and pleasant the summer might be. This leads us to what I call the 3 Ds, the primary destroyers of financial security that become even more dangerous after 50. First is debt. At its core, debt is poison disguised as opportunity. It promises leverage, but delivers chains. For every person who successfully used debt to accelerate wealth building, I've counseled dozens who were financially crippled by it, especially when taking on significant debt later in life. The second D is drama. Unnecessary chaos and complexity in your financial affairs and personal relationships. Drama isn't just emotionally exhausting, it's financially devastating. Messy divorces, bitter lawsuits, feuds with business partners, these situations don't just drain your bank account. They rob you of the mental clarity and focus essential for building wealth. The transformation begins when you actively prune drama from your life and finances, creating space for rational decision-making. Ready to continue your journey towards stress-free financial independence? Subscribe now and get practical wealth-building wisdom delivered straight to your feed. The kind of timeless advice that creates real results, not just excitement. The third D might sound harsh, but it's crucial. Dumb people. Intelligence isn't the issue here. It's about avoiding relationships with the financially irrational, the chronically impulsive, and those who consistently make poor decisions. Financial behavior is contagious. Spend enough time with people who manage money poorly, and you'll likely adopt their habits. The impact of your social circle on your financial outcomes can't be overstated. The power comes from saying no. No to debt that doesn't build wealth. No to unnecessary drama, and no to relationships that consistently pull you toward poor financial decisions. If you've noticed one of these 3 Ds affecting your financial life, type freedom from the Ds in the comments. Identifying the pattern is the first step toward breaking it. Few things impact your financial journey more profoundly than the people you choose to walk alongside you. There's a hidden truth about business and investment partnerships that rarely gets discussed. Their success isn't primarily determined by strategy, market conditions, or even the specific opportunity. It's fundamentally about character, trust, and compatible temperaments. I've witnessed this reality play out repeatedly in my decades of financial advising. Behind the scenes of every successful long-term partnership, whether in business or investments, you'll find people who share core values even when their specific skills or personalities differ. The revelation that transformed my own approach to partnerships came when I realized that values alignment matters infinitely more than goal alignment, because goals change while values endure. Consider the legendary partnership between Warren Buffett and Charlie Munger. What made their collaboration so extraordinarily successful wasn't just their combined intelligence. It was their shared commitment to rationality, their compatible temperaments, and the absolute trust that existed between them. Neither ever worried the other was pursuing a hidden agenda or would make decisions that violated their shared principles. For those building wealth after 50, this insight becomes even more crucial. You simply don't have time for partnerships that drain your energy through constant conflict or ethical misalignment. The breakthrough comes when you realize that with trust, rationality, and patience on your side, you don't need extraordinary brilliance to succeed. Character compensates for countless other deficiencies. This principle of patient partnership connects directly to perhaps the most powerful force in wealth building: compound interest. Einstein allegedly called it the eighth wonder of the world, and for good reason. The journey of compounding is slow, boring, and absolutely unstoppable. It's like watching paint dry, except the paint eventually turns into millions. What most people fail to grasp about compounding is that its true power emerges in the later stages. The first decades of consistent investing might seem disappointingly incremental, but then something magical happens. The curve steepens dramatically, and wealth begins to grow at an accelerating rate. This is precisely why building wealth after 50 isn't just possible. It can be remarkably effective if you understand and harness this mathematical reality. The transformation happens when you shift from seeing time as your enemy to recognizing it as your ally. Even with just 15-20 years of focused wealth building ahead, the power of compounding can work significant financial magic, especially when combined with the wisdom and discipline that typically comes with age. I remember working with James, who at 52 worried he'd started too late. We created a disciplined investment approach focused on high-quality assets generating reliable returns. By 67, the acceleration phase of compounding had kicked in so powerfully that he had more than double what our original projections suggested. The key wasn't some brilliant strategy, it was simply giving compounding enough runway to demonstrate its exponential nature. Few people have the temperament to sit through the seemingly unproductive early stages of compounding. They get bored, they tinker, they chase excitement. But those who develop this patience inevitably build significant wealth, often surprising themselves with the ultimate results. If you recognize the value of patience in your wealth-building journey, type "compound patiently" in the comments. It's a powerful affirmation of the approach that has created more millionaires than any other financial strategy. Now I want to share a profound mindset shift that completely transforms how you approach wealth building after 50. We've been conditioned to believe that financial success is about speed, finding that explosive stock or brilliant strategy that will rapidly accelerate your nest egg. But here's the revelation that changed everything for me and countless clients. Getting rich isn't about speed at all, it's fundamentally about survival. The longer you survive in the market, avoiding catastrophic losses and staying consistently invested, the more opportunity you give compounding to work its mathematical magic. It's a complete paradigm shift from how most people approach investing, especially when they feel time is running short. The hidden truth is that most financial failures don't come from missing opportunities. They come from people who couldn't sit still, who constantly chased excitement, or who tried desperately to look smarter than everyone else. I remember consulting with Thomas, a surgeon who at 57 had accumulated substantial savings but kept sabotaging himself by jumping between investment approaches. Every few months brought a new strategy, a new advisor, or a new can't-miss opportunity. The breakthrough in his journey came when he finally embraced the survival mindset, focusing not on maximizing returns, but on consistently participating in market growth while avoiding catastrophic mistakes. Within 5 years, his net worth had nearly doubled, not because he found some genius investment, but because he simply stopped getting in his own way. This survival principle connects directly to perhaps the most unfashionable financial wisdom of all: living below your means. In a world obsessed with status and appearance, the discipline to consume less than you earn represents a genuine superpower, especially after 50. Modern society relentlessly encourages consumption: bigger houses, flashier cars, exotic vacations, all fueled by easy credit to keep up with the Joneses. This approach works wonderfully until economic cycles inevitably turn, at which point leverage transforms from a wealth accelerator into a financial noose. The transformation begins when you develop a preference for what I call boring wealth. Adequate cash reserves, productive assets that generate reliable income, and the peace of mind that comes from knowing you won't panic when recessions inevitably arrive. This approach rarely earns admiration at cocktail parties, but it consistently creates genuine financial independence. What's fascinating is how this mindset creates not just financial security, but a profound sense of personal freedom. When your identity and self-worth aren't tied to consumption patterns, you gain immunity from the constant pressure to upgrade your lifestyle with each increase in income. This psychological liberation represents a form of wealth that no balance sheet can capture. I've worked with clients across the income spectrum, from school teachers to CEOs, and I've consistently observed that lasting financial security correlates far more strongly with spending habits than with income levels. The journey to wealth after 50 begins not with earning more, but with the revolutionary act of keeping more of what you already earn. If you've noticed how much of our financial stress comes from lifestyle inflation rather than actual income limitations, type "freedom through restraint" in the comments. It acknowledges the counterintuitive truth that constraints often create more freedom than indulgence. As we wrap up today's exploration of stress-free wealth building after 50, I hope you've discovered that financial success doesn't require genius moves or taking enormous risks. It simply requires avoiding catastrophic mistakes, embracing patience, and allowing the miracle of compounding to work on your behalf. You know, I create these videos because I believe so deeply that financial wisdom should be accessible to everyone, especially those in their prime years who still have plenty of time to build significant wealth. If you've found value in this approach, this counterintuitive path to financial freedom, I'd love to have you join our community by subscribing to the channel. Each week, we explore these timeless principles that the financial media typically ignores in favor of more exciting but less effective strategies. If this message resonated with you today, drop a comment saying, "Patience beats perfection," so I know who's embracing this philosophy of steady, rational wealth building. Your like on this video helps tremendously with getting this message to others who might be feeling that same pressure to make dramatic financial moves, when what they really need is permission to take the slower, more reliable path. For those wanting to go deeper into these principles, I've created a companion video that explores exactly how to structure your investments for maximum stability while still capturing significant growth. Click right here and continue this journey with me. After all, wealth building isn't a sprint, it's a marathon where the steady, consistent runners almost always finish ahead of those who burn out trying to set speed records. I'll see you in the next video.